Well, good evening and welcome to the Brian Crombie Show on Canada One TV. I wanted to check back in with Hussein Amed. Hussein is the head of Yorkville Asset Management, an incredibly smart gentleman that takes a look at the economy very closely because he's obviously investing on not only his own money, but clients' money. And so, Hussein, how are you and what do you think of where we are in the economy right now?
Thank you, Brian, and I'm happy to be here and talk to you about markets and economy. The economy looks like it's on the broad surface of things. It looks like it's healing itself from that horrible, let's call them March and April months, and that's on the back of substantial amount of liquidity being pumped into the market from central banks on a global basis, and monetary stimulus both in Canada, US, Europe, and major developing nations and even emerging markets have been pumping substantial amount of liquidity. However, this has long-term implications that are negative, but for the short term, for example, if we take a look at the US, and I speak a lot about the US, but Canada and US follow the exact same thing, that they've added more than $5 trillion into the economy. And what's quite interesting, for example, we've seen total income. This is from wages, salaries, unemployment insurance actually increase at a level higher than pre-pandemic. So obviously people are now, it's weird to say it, but people are making more money on the backs of a lot of free checks being given by the government. And therefore that pushed retail spending back up higher in May and June. And now we're back at pre-pandemic levels. Now,
so what's your assessment? Where did this come from? Is this because we've had mass unemployment, lots of layoffs, lots of furloughs? So is this because the government monies through unemployment insurance and wage subsidies, et cetera, are so remunerative that in fact people are making more money in aggregate?
In aggregate, absolutely. What happened is they gave employers the ability to furlough employees. And as a result of that, the government picked up the paycheck through enhanced unemployment insurance. You add to that, they sent to every individual a check, regardless of he kept his job or lost a job. Every adult in the US, for example, received that paycheck. And then over and above, they gave breaks on, for example, mortgage payments. They gave breaks on student loan repayments. So with all these things, people ended up with having more cash in April and May than they had in January and February. And a lot of them went out and spent it because it's not necessarily a significant amount of cash that they will kind of save it. Or some did, and that's why maybe we're seeing day trading activities increasing. But there was substantial amount of spending of that money. Now, things could start changing now as those programs were intended only for 4 months. And if you remember when we talked earlier, I said, look, you asked me about the fiscal stimulus. I said, depends on how you look at it. It could be insufficient. It could be more than what's needed. Depends on the period that we are going through this. So now every government is talking about additional fiscal and monetary stimulus because that 4-month period, the $5 trillion that they pumped into the economy in the US or Canada, 500 or 800 billion that they pumped into economy, it's coming to an end. It ends by the end of July. So they have to decide what do they do going forward. Do they extend these programs for another 4 months, which means also pumping another 5% of the economy from in one form or another? There's debates on both in different sides of the political aisle in best way of doing it. But so far that money has helped a significant recovery in May and June in equity markets, in retail spending, in everything. And also we're seeing unemployment level, other than this week, we've seen unemployment level actually drop to 11.3 or 11.1%. That's because a lot of companies that furloughed employees have to start taking them back. But if now we hit second wave, which seems like it with Florida, Arizona, Texas, and California, and an extension of the unemployment insurance, we might see another wave of furloughing employees and even more permanent unemployment.
So I've heard that some American companies are having challenges actually getting people to come back because the unemployment insurance benefits are so attractive. Do you think that's a problem, that it's actually creating a disincentive to get back to work?
I agree with that statement. I think that they've made it so tempting for a lot of people that it's hard for an employer to convince an employee to go to work. We've seen it in long-term healthcare, for example, where environmental staff, janitorial services, they actually make more money staying at home than being on the job in Canada. So we've seen it in real life, and that's a challenge for businesses that want to try to reopen up. So that's why the debate, for example, now that exists in most countries, do we go and enhance unemployment insurance, or do we give tax subsidies to the employers and allow them basically to stimulate spending on that front by cutting taxes? So there's that debate that's going on, but I think most of those topics will be resolved, if not by the end of next week, it's just the week after. By the end of July, they have to make these decisions.
Different countries, and Canada and the United States are among them, had different strategies. Canada was more focused on the wage subsidy, hoping that companies would keep people employed, and they wanted to give the money to the companies to then distribute to the employees. And in the United States, it was no, directly to the employees and via unemployment. And that's mirrored in other countries around the world. Do you have a sense of which strategy is the better strategy?
I think both have their successes and challenges in many ways. It's hard to tell on the short term. I, as an employer, would rather the subsidy to be given to an employer because we are more in touch in terms of what we need to do in that sense. But also I am cognizant of the fact that our unemployment insurance plans were already deficient before COVID-19. So the system that was designed in the 60s needs significant redevelopment. So that, I think that will be changing. But I think both programs had their successes and challenges.
The last time we chatted, you were talking about a need for a dramatic increase in the fiscal stimulus. Do you still think we need that dramatic increase in the fiscal stimulus?
I think yes. I think we're on one part I was right, on one part I was wrong. I think I'm right that the fiscal stimulus need to increase because from a mathematical point of view, when you impact the burden of the unemployment, the burden on companies, on projects, all this, there needs more in terms of spending from the government to pick up the slack that the business is now, or the consumer is not doing or is not spending in the way that they do. So in that sense, we were right. Where we were probably wrong, which is the questions that are being asked now, should we cut the checks directly to the consumer? Should we give the employer the incentives? Is it an enhancement to the Unemployment Insurance Act? Or is it cheap financing for businesses? So now that we can step back and take a look at it, we know two things: that the problem is not going away. We are seeing massive resurgence in cases in the southern part of the US and the western side. We have seen an increase in cases even in Ontario and in Alberta. So that second wave that we used to talk about that is going to come in November is coming earlier, but fortunately for us, we went through it first time around in March or February and March. So now we can look back at it and assess these programs and decide which is better way. And I think a bit of there's never one way that is more accurate than the other. All these programs need to be looked at, measure their effectiveness, their contribution to the bottom line of the economy. But ultimately, the biggest challenge is employment. You need people to get back to work. You need people to earn their income. And that will help businesses, will help entrepreneurial drive. And I think that should be the main focus, is how do we get people back employed? If you just pay them to stay at home, it's a challenge. But also we do have another challenge on the personal front type thing. If you have somebody that has kids at home and there is no daycare, or they don't trust the daycare system to protect their kids? How could you send these parents back to work? So you have these challenges that we gotta find a way to overcome.
So, you've mentioned twice now the resurgence in the United States. Let's talk about it. So, California, Texas, Arizona, Florida, Georgia, all opened up too early, some people would say right now. And frankly, they may have closed down too late as well. And the statistics are worrying. There are all-time high infections, all-time high mortality. The positivity rate on testing is above 20%, which some people describe as sort of breakaway infection rates in the community. And the ICUs are above 100, 130% capacity in some cases. Do we have to close down again there?
I think those states were a little bit ahead of the science. And also earlier on, if you remember, I mentioned to you, we've been investing in healthcare for a good 25 years. And this virus is a little bit different than other viruses. And we didn't believe the story that a vaccine will take 6 months. In fact, when we did the modeling, we said the vaccine will be in 2030. And then we said, okay, if they expedite everything, it will be 2022. And they're spreading hope, saying vaccine will be here by year end, maybe, but we doubt it. What these states did, they were ahead of the science. And at that time, the science indicated that this virus is not spread via air. It's not an airborne virus, or it doesn't stay alive on surfaces. Wearing a face mask is not required. Washing hands is the only thing that you need to do. Now we find out that, hey, it's not airborne. Definitely it's not airborne, but kind of it lives in the air for a little bit longer than they thought. It also lives on surfaces longer. You need a face mask whenever you're indoor, social distancing norms. So those states opened up before this kind of these discoveries, or these, they were on the initial assumptions when we knew little about the virus and how it's transmitted. And unfortunately now they are living with the consequences of their actions. Versus in places like, let's say, Canada, Ontario, or Alberta, where we took a more conservative stance, and we said, no, we're going to stay at home till we figure this out. And even now, we just have to open up because the economy needs to keep moving. We're not opening up because we think we're safe, or we're over it, or we're close to a vaccine. Versus those states, you'll find the spread of the virus is at a lower pace. The infection, the deaths has de-accelerated substantially, that you could start opening parts of the economy. So those states were wrong in jumping ahead of the science, and without the knowledge of the impact of face masks, social distancing, the use of hand sanitizers, all this. They assumed, they continue to function, that this is no different than any other virus. The death rates are similar. Why should we shut down? And now, unfortunately, the consequences of that for them is going to present a lot of challenges.
So what do you think is the right public health and political decision? From an economic standpoint, clearly they would like, since they have reopened, they'd like to stay reopened. And I think that the concern's got to be that if I all of a sudden close these restaurants, close these businesses, close these facilities, close these offices down again, that people will lose confidence in the ability to go into life in a healthy manner. But if they don't close them down, they've got a risk of infections and mortality skyrocketing, the ICUs being overrun. So if you were governor of Florida or Georgia or California or Arizona or Texas, what would you be recommending today?
I think those they have to go back into the closure, partly for the containment effect, to contain it in such a way to flatten the curve. So they're facing what we or New York faced in March. So they have to go into the shutdown. Versus in other areas where they don't have to go to the shutdown, they just have to be careful and phase in things at a slow pace to allow the science to catch up with where we are. Because eventually we'll find out a lot more about this vaccine, or not the vaccine, sorry, about the virus, but also the ways we can treat it, or the ways we can help a patient recover faster. We don't necessarily have to find vaccine, but there's ways to handle the situation that is better than what we did in April or March. So if I was there, I would definitely go into that shutdown because containment is the key priority at this stage. Then do a gradual opening, similar to what we did in Ontario, where they opened parts of the province where social distancing is the norm, as opposed to downtown Toronto, where the congestion and the apartment buildings and business offices, and it will take you now, if even they say go back to work based on the social distancing work, if you work on the 50th floor in TD or Scotia Plaza, it will take you an hour to get there. But this is over and above the commute that you got to do to downtown. So it's quite challenging. So I think, yeah, they'll have to contain it in one way, and closure is shutting down is might present a political problem, but it probably is the right thing to do, or else the cost will be substantial. You got to remember, there could be actually people like in Ontario, we've seen class action lawsuits against long-term healthcare operators, but there could be class action lawsuits against the government for not taking appropriate action. And we have cases in the past where somebody proved government has did not tell the truth, did not share information. We see settlements till today against government that actions that they did 10 or 50 years in the past. So there is a liability that does exist on the political infrastructure that they have to be careful.
We're chatting tonight with Hussein Amed. He is the CEO of Yorkville Asset Management. We're going to take a quick break for some messages and come right back. Stay with us. Welcome to the Brian Crombie Show on Canada One TV. I'm chatting tonight with Hussein Amed. He is the head of Yorkville Asset Management. It's a downtown Toronto, but also across Canada, money management firm where he invests on behalf of himself as well as clients. He does these economic presentations a couple times a year that I've been honored to be invited to. And I have found him to be incredibly knowledgeable of what's going on in the economy, but also the implications of what's going on in the economy on the market. And so Hussein, we've talked a little bit about the economy and we'll talk undoubtedly a little bit more about it. But given what you've described in the economy and public health, how's the health of the markets today?
Well, the markets have reacted positively on a couple of factors. One is the massive amount of fiscal and monetary stimulus. And basically the government giving a guarantee against the default of certain issuers. So if you're an investment grade issuer of debt before COVID-19, they're not going to let you go in default. Now, we've seen other companies like Hertz and others where they had to declare bankruptcy, but these were never investment grade to start with. So the S&P 500 generally reacted positively to that news, the massive amount of liquidity. The second thing is that they pushed interest rate across the entire yield curve to generational or historical lows. I think the 10-year treasury is trading a little bit above 50 basis points, 0.5%. And when interest rates is low, and interest rate is the denominator in the discounted cash flow formula, you can get an inflation in stock prices. And that's what's happening. So stock prices moved aggressively higher from their March lows. Now, some cases it's driven by that valuation formula. In some cases, there was a massive amount of retail day trading where they were bidding the price of Hertz up 4 times. I think Hertz more than quadrupled in price in a period of 2 weeks and then declared bankruptcy. Chesapeake Energy, the same. I think it doubled on a Monday in June and then after hours declared bankruptcy. So
what that suggests is that the market is completely divorced from the reality of what's happening with the companies.
There is an amount of that, but if you take a look at who's buying these companies that are facing challenges, 95% of them are retail investors, the day traders. If you do a research on mutual funds or hedge funds and see how many of them actually owned any of these companies, zero. They didn't own them. We would never buy them because we know the fact. It's more that the retail gambler mentality. This existed in 1999 and a little bit in 2007, where, hey, just because it's cheap, I should buy it. And there's a disconnect in understanding between Hertz as a company continuing to operate after bankruptcy with the same name and the destruction of the share value, where the share owners will lose everything.
So I'm not sure whether this list is completely accurate, but let me just read you something that I've got here, if I could. Victoria's Secret declares bankruptcy. Zara closes 1,200 stores. Le Chapelle withdrew 4,391 stores. Chanel is discontinued. Hermes is discontinued. Patek Philippe discontinued production. Rolex discontinued production. Nike has a total of $23 billion US in layoffs. Gold's Gym files for bankruptcy. Founder of Airbnb said that because of the pandemic, 12 years of efforts were destroyed in 6 weeks. Starbucks announced permanently closing 400 stores. WeWork is in challenges. Hertz files for bankruptcy. Comcar files for bankruptcy. JCPenney files for bankruptcy. Warren Buffett loses $50 billion. BlackRock is signaling disaster in the world economy. Biggest mall in America stopped paying mortgage payments, Mall of America. It goes on. What's going on? How can you have all this and the stock market be at a high?
Well, we have to be also, how do we interpret this data? The bulk of the names that you've listed were in the retailing sector, and the retailing sector is the hardest hit sector. That's number one. So they're not in, if you take a look at the technology side, for example, it's at the opposite end of the spectrum. Everybody's shifting. In Canada here, Shopify becomes the largest company on the TSX and surpasses Royal Bank, and soon will become one of the largest global companies, not just the largest Canadian company. It continues doing the deals with the Walmarts and the deals with PayPal and so forth. So those are the opposite end of the spectrum. And there is no doubt that retailing sector that requires massive amount of consumers and daily shopping in shopping malls and so forth is in many ways beyond recovery. And there's a shift to more the online buying. Even consumers now, even the malls are open, you gotta go put a mask, but you're not gonna wait in line for 40 minutes to go into your favorite store, whether it's Nike or Lululemon. You might as well order your stuff online and you'll get it at home and you can send it back. So there's also a shift in pattern of how people are buying. And in some companies, they cannot adjust for that because just the nature of the product. So unfortunately, bankruptcy is a way. There's another thing about in the US in particular, bankruptcy in the US does not mean any one of those brands that you mentioned, we will not see in 2021. We will see just a restructuring plan that allows them to get out of their fixed obligations. Those are debts, leases, these are, and even employment. It allows them to renegotiate employment contracts. It allows them to get out of these expensive leases. You got to remember, most of North America, if you wanted to rent a space in Square One in Toronto or in Mall of Americas, per square foot, that space wasn't cheap. So if you want to get out of it, one way is that declaring bankruptcy. If you don't want to, if you have amassed a massive amount of debt and you have very low margin, operating margin in terms of the ability to generate cash flow, and now there is no sales, bankruptcy and restructuring the business and getting those creditors off your back is a way to go. So many of these companies you talked about, we will see again, but they're restructured. So it's not like they survived. They tend to maintain their names. They change the business model. They reduce their retail footprint, but now they don't have these obligations of debt.
The company might survive, but the share price won't be worth much.
Oh, the share price is disappearing. But again, if you take a look at who owns these companies, you wouldn't find any of the good mutual funds or hedge funds owning any of these. I mean, we own Starbucks out of that list that you mentioned, but out of that entire list, we do own Starbucks. We continue to believe in their business model. But even with owning Starbucks, and I have to be very careful of when I mention a specific stock, but when the crisis started, we substantially reduced our allocation to Starbucks in February or March. And we just said anything that's retail oriented is going to, as much as we love the company, we love the operators, we love their approach. And certainly I'm sitting here still having at home, still having a Starbucks coffee. But we also know, for example, that breakfast is 30% of their top line. If people are not going to the office to work, that's 30% of their top line is going to disappear. Their operating profit margin is roughly 30%. So that's going to wipe out their entire profitability throughout this period.
What about the whole travel industry? You know, we talked about Hertz, but airlines, car rental companies, hotel companies, what's going to happen there?
Yeah, we used to own a few. We've exited in the past month. We bought a little bit more, kind of the buy low, sell high from good operators. Let's say Marriott and MGM and Delta Airlines. Very, very small positions in them. Again, the more they drop, the more we will add, because at the end of the day, that business will have to go back. The biggest worry we have is bankruptcy, because the ultimate loser is if you invest in a company that declares bankruptcy. But if a stock is down 80% from its peak and they receive a grant from the government that allows them to pay their fixed obligation, and it's a grant or a free loan, we could see that those companies recover. Now, nobody's planning any serious vacation or travel, because nobody wants to be stuck somewhere and getting tested positive for COVID-19. That could ruin anybody's vacation. Nobody's gonna book cruises. So for the time being, these companies' valuations have to adjust substantially lower based on the number of flights or the number of guests per hotel and so forth. Like, I know hotels in markets we operate in, whether it's Calgary or Ottawa or Toronto, they're starting to open up, but they're also not booking to full capacity. Like they used to book almost used phone. Now they're at 40% capacity. It's by design to keep social distancing so that they can also have the time to do the proper cleaning procedures and so forth. So I think for the time being, it's going to continue to be challenged. At least till the end of the year, I would say. But you got to remember, stock markets is looking forward as an instrument. So if we think the recovery in travel is going to happen next year, you start seeing the recovery in the stock prices now. It's a forward-looking instrument. If we think the delay is longer, then you got to say the prices will be more challenged, and eventually you could see a bankruptcy or two in those sectors.
What about the shared economy, Airbnb, Uber, companies like that?
Uber still seems to be working. Maybe there's substantially less demand. And Airbnb, their business model is quite interesting because they don't own the vehicles. They don't have employment contracts. They earn a spread basically on every time. So their margin is going to get compressed, obviously, and the valuation is going to be lower. Okay. The same as with Airbnb, not a lot of people are going to allow their properties, unless it's an empty property, to be rented. But nobody's going to rent that extra room in their home, at least for the time being. So those, you could see their profit margin being compressed. But there's good news, bad news, in a sense that they don't have the heavy burden of debt and leases like an airline, American Airlines or Canada, Delta or whoever. They don't have these burdens, so they can adjust. But nevertheless, the stock market of them, their valuation should be way lower than what it is now.
What about the impact of global supply chains being dramatically restricted? I've talked to so many companies that think that this sort of era of globalization has, if not come to an end, certainly fallen in disfavor, and that you're going to have a lot of re-onshoring and restrictions on global supply chains. And it comes from, certainly President Donald Trump restricting the importation into Canada of masks, but a whole bunch of attitudes in regards to difficulty in global commerce, global trade.
Yeah, I think for the time being, the U.S. is experiencing a fundamental shift in policy. They go from being the policeman of the world we live in, the enforcer of the rules, um, uh, pushing for the economy, the world is flat type of thing, pushing for opening of emerging markets. I remember I used to be in international banking. The US would always argue that these markets are closed and they need to open up because the US sells to these markets, whether it's the Vietnams or Brazil or this. And now the US policy is going through a shift. I'm not sure if it's shared across both sides of the aisle, but at least President Trump is taking the economy in that, the country in that direction, that it's more US first. And realizing also that the US is a major source of wealth for many economies around it, including China. I mean, the US is one of the largest importer of products from China. That means they pay the Chinese for producing their products. So there's a shift in that policy for the time being. The US election might slow that down or turn it totally around. But if Trump is elected for the next 4 years, those supply chains are going to become harder to manage and harder to continue at least producing in China. So there might be a shift. We're already seeing a shift from some manufacturing that was in progress or in plans in China being shifted to India, or being shifted to South Korea, or somewhere which is the cost of it is more expensive in terms of the wages per hourly, per labor type of thing. So we're starting to see those shifts, but unfortunately, those will take another 10 years to go on. So we might see actually before the major shift, we might see that whole the foreign direct investment in other countries drop down substantially, which means emerging markets that were poor already will become poorer, because without developing nations investing in them and putting manufacturing facilities and employing people, even we could argue that it's they're not being paid fair when they're working for 60 cents an hour or $1 an hour. I don't know actually the exact wage, but we could argue that is not fair for that employee over there. But nevertheless, that $2 or $3 an hour is triple what they would get by being employed in their own company.
Is concern about that impacted currencies of emerging markets and or emerging market funds?
I think there is a massive shift a little bit in asset mix, and they mask it, at least among US fund managers, out of some of these emerging markets into more of the developed nations. But the problem is that it's also President Trump is making challenges also in transacting in Canada with France. Like he's also, other than their strategic ally, which is the UK, other than that, in most countries, he has presented numerous challenges. Like in Canada, NAFTA, for example, is scrapped, and whatever they put in place is going to get even worse if he gets elected. So it's going to become challenging for many countries.
What's happening with gold?
Well, we bought gold, can't remember the date, but I'm going to say in mid-late April. We have about substantial exposure to it. Big part of it, when you have interest rates at zero or close to zero, and you have an inflation, we've seen a little bit jump in inflation in the May and June. And you get flight to quality, you get, it tends to be supportive of the price of gold. Now, when we bought gold, it was in the 1600 level. Now it's 1800. And banks now are publishing that gold should be in the 2000. And the reason they're saying that is that in wave two, we could see further cuts to interest rates, further monetary stimulus, further destruction in foreign exchange in aggregate. And as a result, gold or precious metals in general is a good place to be.
So just to finish up here, and this has been really interesting, Hussein, thank you so much. Are we in a recession, coming out of a recession, in a depression, coming out of a depression, or who knows until we get a vaccine?
It's quite actually interesting because we were talking today with our head of our fixed income, Rob Featherby, who's did an amazing job with our fixed income portfolios. And he was pointing out that the US or the yield curve was indicating that the US is heading into a recession before this pandemic. So kind of in August, September, there was an inversion in the yield curve, and it indicated that the US economy will head into a recession in the next 3, 6, or 8 months. Then you get COVID-19, and you get this massive amount of stimulus being pumped into the economy. So it kind of, it's like when you say the black ice, you can't see what's underneath that ice. And he's cautioning that, hey, things could go bad very quickly on different fronts. And that's why probably we see the shifts also in equity markets, that not all sectors are treated equally. We see kind of the heavy industrial, economic sensitive sectors not doing well, and there's a shift more towards the healthcare, the e-commerce, which is in the case of there's a recession, they should do reasonably well. But I don't think we are in a recession at this moment in time from the classical definition. Probably we are, but I don't think that is going to be the biggest worry. But we have, if you look at the elements of a recession, we have massive amount of unemployment. I think we have about 16 million Americans now unemployed. Mind you, we could see a spike in that if they extend the unemployment insurance for another 4 months. We could see it go back to 25. We have substantial amount of discouraged unemployed, meaning people are not looking for a job anymore. That jumped quite substantially. So that's a challenge on one side. Sales and earnings are no longer as predictable as they were in the S&P, for example, as they were before, because every company is telling us something different about their forecast. So there's a lot of challenges. So we could slip into a recession very quickly. What could keep us out of a recession is further fiscal stimulus and monetary stimulus, which seems to be in the cards from the discussions that are happening this week, whether in Ottawa or Washington or London or Paris. Europe did a monetary stimulus early this week. I think it's in north of $800 billion. So I think the US is talking about $1 trillion and Canada a similar amount, adjusted for population about maybe $100 to $200 billion. So I think without that stimulus, definitely we will slip into that traditional recession.
Hussein Amed, head of Yorkville Asset Management, thank you so much. You had started out by saying that the stimulus was great in the short term, but long term it would create a problem, which I presume is way too much debt and austerity. But let's leave that for another conversation sometime on how we deal with it in the future.
Absolutely.
If people want to access your economic information and things like that, have you got a website they can go to?
Yeah, yorkvilleasset.com. Everything we talk about, there is recorded podcast and webcast, and all that stuff is available online.
Hussein Amed, Yorkville Asset Management, thanks so much for your time this morning.
Thank you very much, Brian.
Appreciate it. Well, that's the Brian Crombie Show for Canada One TV for today. Hussein Amed, head of Yorkville Asset Management. I really appreciate you joining us. Thanks so much. Good night.
Thank you.